I'm Matt Bishar, and I'm at the Lachance Resort and Club in Palm Springs for REITwise 2017, NAREIT's Law, Accounting, and Finance Conference. Joining me today is Cedric Lachance, Director of U.S. REIT Research with Green Street Advisors. Cedric, thanks so much for joining us.
Happy to be here.
Given the recent operating results, what is Green Street's view for the direction of real estate values overall?
So over the last year or so, our commercial property price index has largely flattened. But your question, of course, about the future and what do we think for looking forward. What we like to do is compare private market real estate values with two different indicators. One of them is comparing expected total returns on real estate with corporate bonds, both investment grade rated and non-investment grade rated. When we make that comparison, we'd say that real estate is a little bit on the cheap side versus bonds. However, we use a second indicator as well, which is comparing REIT prices with their private market values. So basically, where are REITs trading versus NAV? And from that standpoint, REITs trade a discount to NAV. And while the public market is not always right, of course, on what will happen, directionally, it's an interesting indicator. When you blend the two, you would say that private market real estate values are probably going to be about flat over the next 6 to 12 months.
And lastly, how do you think about which property sectors are going to provide the best returns going forward?
So we like to think of sector allocation rather than sector picking. And what we mean by that is what will happen to REIT prices over the next 5 years rather than the next 6 months or so. So we tend to divide the REIT universe in about a dozen sectors. When you do that, there are 4 sectors that currently look attractively priced. It's manufactured homes, storage, apartments, as well as malls. So 3 of them, manufactured homes, storage, apartments, tend to be cheap regularly in our readings, and that's primarily because they really enjoy a combination of low capex as well as good NOI growth over the long term. The mall sector is a bit differentiated here. The mall business has struggled tremendously with what's happening to department stores. The department stores will cull their store fleet undoubtedly. And with what's happening with e-commerce as well, consumers are clearly voting with their feet. So the mall business is really in a period where it has to reinvent itself. But in the public market, the mall business is really represented by the A malls, and A malls are likely to be the winners over the long term in the business. And given the tremendous recent underperformance of the A malls, we think that there's an attractive entry point.
Great. Cedric, thank you so much for joining us.
You're welcome.
For more from REITwise 2017, be sure to visit NAREITsREIT.com.